So we're going to talk this morning about why I believe gold stocks represent the best risk reward for the year ahead. And I should really say not just a year, but I think for the next several years. You know, you could probably ask, we've had a lot of publicity about gold in the last maybe week, 10 days. There was a great article or interview with Mohammed Al-Arian this morning in the Financial Times, if anyone saw it. But, until recently, gold just simply hasn't been getting the attention that it should. And this graph here just shows you that gold actually over the past 12 months and also over the past 3 years has outperformed the S&P. Normally, something like that will get a lot of attention. Now, why has gold been going up really here over the last couple of years, last 3 years? I think we all know the reason. It's central banks. Central banks have been buying gold steadily and heavily. 2022, 2023 were records. And 2024, you can see here, this is just a half year. So will also be another good year. Interestingly to me, although China is has been the number one central bank buyer, People's Bank of China, when they stopped, or paused, I should say, when they paused in May, so they haven't bought any gold for June, July, August, and September, central bank buying still continued. And that just tells us that although a lot of people 6 months ago or a year ago thought it was just China buying, that's a false narrative. The buying from central banks has been very, very broad. So central banks, as we know, have been the main source of buying over the last couple of years. The second largest source of buying over the last or really over this year, I should say, started in January, has been Chinese consumers. And you can see here, this is just a reflection of that. This is the trading activity. And of course, trading involves a seller as well as a buyer. But this is the trading activity on the Shanghai Gold Exchange. You can also look at indicators like gold imports into Hong Kong. And it's quite clear that Chinese consumption of gold this year has absolutely shot up. And those two buyers, central banks and Chinese consumers, have been by far the largest purchasers of gold in the last year, as we know. And what about in the West? What about Western investors? The dark blue line here, this shows you gold ETF buying over the last 15 months. The dark blue line is North America and the light blue line is Europe. And you can see that up until July, there was net outflows from Western gold ETFs. When you think, we all think of gold now as being over 2,700, but remember, for most of this period, gold was making new highs week after week, month after month. And yet, until the last couple of months, we had consistent outflows of gold. And I'll talk a little bit later about gold funds. Equally, though, and very importantly, I think, just in the last couple of months, the Western demand for gold has turned upwards. And we'll talk about why that is in a second. So, up until, let's say, July, if you read the headlines, you would think that in the US we had high interest rates, low and declining inflation, and therefore high real interest rates. We had a strong economy. We had a strong stock market. We had a reasonably strong dollar. And that is precisely the macroeconomic environment that is actually the worst possible environment you can think of for gold. And so when people used to say to me, why are there outflows from the gold ETF, from GLD? Why aren't people buying the gold fund, etc., when gold is making new highs? It really was perfectly logical, because the people that have been buying gold over the last 2 years were not buying because of a macroeconomic environment. They were buying for their own purposes. We know why central banks were buying. And Chinese consumers were buying because they wanted a place to put their money outside of a banking system. The stock market, of course, in China has shot up in the last couple of months, or the last month, really. But until then, the stock market was a one-way street downwards, nervous about real estate. And so gold was, and you can't buy Bitcoin. And so gold was an obvious place for Chinese people to put their assets to preserve purchasing power. And again, we know why central banks were buying. So these factors, what was driving gold, had absolutely nothing to do with the macroeconomic environment. Now, I would suggest to you that the macroeconomic environment is changing. I mean, clearly the Federal Reserve has just cut rates. We know that. And the trajectory is definitely going to be south. I believe, we can discuss this, but I believe the economy in the US is nowhere near as strong as the headlines suggest. And we know from every single time that the Fed has started to cut rates after the Paul Volcker era, gold has shot up. And that's logical. But every time the Fed has started to cut rates, the gold has shot up. And this year, this charge only goes up to 2022, but this year, obviously, is no exception. And so what I'm saying is that the normal reasons people buy gold, investors, small institutions buy gold, are now actually in place. And they are going to be more prominent as the months go on. Now, people sometimes say, you know, I'm very nervous on the economy. As I've just said, I think the economy is nowhere near as strong as the headlines suggest. That's a matter for debate. But for this talk, people say to me, oh, well, we're having a recession. Surely that's bad for gold. No, not at all. You look back at the last, I think that's 7, I can't count, 7 recessions back to the 1960s, you see gold actually went up in every single case except one, and that was in the early 2000s when the European central banks were heavily selling their gold, if you remember. As for the gold stocks, they've gone up in a majority of recessions, and I'm simply looking at the National Bureau of Economic Research definition of a recession. I'm taking their timing of it. Gold stocks have gone up in a majority of recessions. And interestingly, as you can see, on the occasions when they've gone down by 3%, 5%, 6%. On the occasions when they've gone up, it's 24, 37, 77, 190%. So I think we could say that on balance, gold stocks seem to be a pretty good asset to own during recessions. And interestingly, in every case except one, when the gold stocks were down, they still outperformed the S&P. So I think we can say that gold stocks are not only probably a good place to be in a recession, but they're better than the S&P. I'll just point something out. I don't like people who sort of play with statistics in order to get the answer that they want. So, and I didn't do that here. But I will just point out that if, in fact, you took 1 month after the beginning of a recession, then the gold stocks actually went up in every single recessionary period. And there's a reason for that if you think about it. Typically, at the onset of a recession, you often get a stock market decline, and in a broad stock market decline, typically the gold stocks do move down initially before they tend to recover sooner than the broad market. But anyway, what about, so that's gold and recessions. What about inflation? You know, I think if you look at this table, and I'm using the core PCE, which is the Fed's preferred measure. That's for people who don't eat and don't heat their houses and so on. But you could use the same table for many other things. So this is the core PCE. Obviously, it's come down since the post-COVID era, obviously. But what's clear from this is we are still significantly above where we were in the pre-COVID era, significantly above. And number two, we're still significantly above the Fed's own arbitrary target, right? Their arbitrary 2% target, which is nonsense, because if your mandate is to preserve the purchasing power of a dollar, your target should be 0, but that's something else. And so I think we can say that inflation is stubborn. I think that's true to say. And if you look at the last 4 months, we've started to see inflation numbers pick up again. And so what does that suggest? Sorry, let me just look globally. This is inflation globally. And as you know, most central banks around the world also have that 2% target. And right now, global inflation is running at almost 6%. So again, a multiple of that target. So to me, inflation is nowhere near under control. And of course, you know, the key is the poor Volcker was able to control inflation. Debt was a lot lower back then, of course, than it is now. But he was able, he controlled inflation by moving rates significantly above the rate of inflation. He got rates ahead of inflation, and we've never really done that, nor have most other economies around the world. So we have a slowing economy and we have stubborn inflation. And what does that spell? That spells stagflation. And if you look back to the early 70s, gold has been the best performing asset in stagflationary periods. This table here that I got from Numera doesn't include gold stocks, but gold stocks will be the second best performing, and then commodities. This has US stocks and US bonds, but actually all developed market stocks and bonds underperform during stagflations. And so if we're heading into a stagflationary period, and it doesn't have to be a repeat of the 70s, but just stubborn inflation and stagnant economy, that is positive for gold. Let's look at stocks. Let's skip over that. Let's look at stocks. Again, I think when you think that the gold stocks have outperformed the S&P for the last 6 months, for the year to date, for the last 12 months, you would think that it would be getting more attention among investors than it actually is. And this is gold versus gold stocks versus gold. Year to date, year to date. And so what you see here basically is that gold and gold stocks have pretty much got the same performance year to date. You could go back for just 6 months, the gold stocks are a little bit ahead. For the last year, they're a little bit behind. But basically, they're more or less in line. This is very unusual. You look back at the beginning of every other gold bull market. From the time that gold bottomed, and I've got different periods with different time frames, the gold stocks typically outperform by a very, very dramatic amount in the early stages of a bull market. I won't read the numbers, you can see them here, all the way back to 1986. Now, why have they not outperformed this time? And again, it comes back to what we were talking about at the beginning. The reason gold has gone up for the last 2 years has nothing to do with the normal environment and the normal reasons that people buy gold. So my thesis, my argument, if you like, thesis is a little too pretentious. My argument would be that with the Fed's rate cut last month, and with increasing signs of a slowing economy, my argument is that in fact the gold market is a normal gold market is just beginning now. So if we time this from now, I bet you that in January we'll look at this and we will see significant leverage from the gold stocks to the gold over the period from September. So the gold market is really just beginning. Absolutely. Hi, thank you. Now, we talked earlier about the outflows from the GLD and the gold ETFs. Look at the GDX. You know, I've just got 3 months here, but we could extend it back to the beginning of the year. Up until September, You had steady and consistent and heavy outflows from the GDX. Even though gold was going from 1800 to 2000 to 22 to 25, you still got these significant outflows from the GDX. I can tell you, managing the Euro-Pacific Gold Fund, we have had, up until really the last 4 weeks, we would have outflows maybe 3 out of 4 days. And the days when we got inflows, I kid you not, were like 11,000, 5,000. You know, that doesn't even pay the custodian for the day. And even now, there is no great flood of money into ETFs, but you can see into gold funds, but you can at least see that it's turned, and that is very dramatic. But still, for the last 3 months, you've had 54 million net outflows from the GDX. If you take away the last month and look at the 3 months prior to that, you had like 120 million. That's significant money flowing out, even as gold is making new highs. And again, it just comes back to this theme that gold has been going up for the last 2 years for reasons that are not connected with a normal gold market. The normal gold market is just beginning. Now, the good news, you know, I said gold, where is thy leverage? The good news is that despite record highs in the gold price, the gold stocks are still undervalued. We could look at price. You know, Barrick, for example, is $21, under $21 today. It was over $30 in 2020, let alone over $50 in 2011. But that's price. And as Oscar Wilde reminded us, there's a big difference between price and value. Look at value. This is Agnico. I pick Agnico as the third largest mining company. I pick Agnico because there's nothing that anybody can look at Agnico and say, oh, well, that's because, right? When I look at Barrick's valuations, everybody says, oh, well, that's because of Pakistan. When you look at Newmont, oh, well, that's because they just bought Newcrest. There's no because with Agnico. They've got strong political risk profile. They've got a strong balance sheet, strong management, good mines, deep pipeline, etc. You look at the price to cash flow, that dotted line at the end is what their price to cash flow for the third quarter is expected to be. We'll know next week. And that is in the lowest 10 percentile of their 40-year history. Now, normally when the price of gold goes up, the multiples expand. You saw that in 2011. Well, this doesn't go back to 2011, I'm sorry, but you saw that when the gold price moved up in 2018, you saw it in 2011. Typically, when the price of gold moves up, the price of gold stocks moves up, the multiples expand. But right now, Agnico is trading at close to its all-time lows in terms of price to cash flow. We could look at Barrick. Again, there's reasons that Barrick would have a discount, but Barrick is trading within 5% of its 40-year price to NAV low. And I ask you if that really makes sense. I don't think it does. So we're in a situation where gold is at record highs and the gold stocks are still very cheap. The XAU is, I did this before I came up here, so the numbers are a little out of date. Unfortunately, gold's been moving so much. But the gold stocks are actually lower valuations than the S&P. And that's a very unusual circumstance for people who've been following this sector for 40 years. Normally, the gold stocks trade at premiums. And they trade at premiums because to buy a gold stock, you've got to kind of be an optimist. So you're willing to pay for the future. But right now, they're trading below the valuation of the S&P, which is unusual. How about sentiment? There's lots of ways we can look at sentiment. I've mentioned the outflows the flows for gold ETFs and for gold mutual funds. This is from Bank of America. And you can see that almost 80% of advisors hold less than 1% of their portfolios in gold assets of any type. I would be willing to bet that most of those actually own zero. I wish I'd asked a question, who owns zero? But anyway, nearly 80% own less than zero. Traditionally in the US, you would have over 2% of gold assets in gold across the broad spectrum. Another indicator to look at is mutual funds. All the way back to when I started in this business, all the way through to really 2011, 2012, you could look at any mutual fund you cared to, a big cap US, a global value, an emerging market, whatever mutual fund you cared to look at, they would all have some gold in a portfolio. When you look today, outside of other than gold funds, dedicated gold funds and resource funds, gosh, I don't know. First Eagle, I think, is the only generalist gold fund that has a generalist fund that has any gold in it. But most of them don't have any. That's going to change as well. So here we are with low valuations and very, very, very weak sentiment. And the gold sector is small. Again, I did this 2 weeks ago, so the numbers have changed a bit. But the gold sector is small. If you look at the valuation of all gold stocks around the world, it's around 600 billion. That's tiny. And just compare with Microsoft, over 3 billion. The largest gold mining stock in the world, Newmont, is only a little over 60 billion. I've got Tesla at 214. Don't think that's their market cap. That's the value of the shares that they trade in a single day. I've got NVIDIA 220. Don't think that's their market cap. That's how much NVIDIA can go up or down in a 10-minute period. 10-minute period. So in half an hour, the change in NVIDIA is more than the entire gold sector. This is a small sector. Now, what does that mean? When you add all these things together, if we're just starting this gold market, if flows are just beginning to move in, if the vast majority of investors are significantly underweight gold, and we have a very small gold sector, well, what does that mean for the gold stocks? It means explosive moves. And it's what we've seen in every, excuse this graph, I had to take it from an old copy of Barron's, but this is the Barron's Gold Index. The XAU wasn't around then. But you can see in the 1970s, the gold stocks moved up 1,300%. From 76 to 80, they moved up 800%. From 2001 to 2008, they quintupled. From 2009 to 2011, they almost quadrupled. That's only 2 years, by the way. A quadruple in 2 years isn't too bad. I mean, I'll take it. And remember, this is the XAU I'm looking at. These are the big cap stocks. When you start, as the bull market develops and more and more investors move, down the food chain, as we say, the junior stocks will well outperform the big cap stocks, and so you'll get gains that are significantly more than the ones I've said. Now, I ought to say, as the SEC always reminds us, we have to keep posting. Past performance is no indicator of future performance, but as Winston Churchill said, it's probably the best way to bet. So anyway, I finished what I had to say. Does anyone have any questions? Happy to take questions. Yes, sir.
You're talking the size of the global gold market. Isn't that the essence of the problem? The entire gold market has become too small, but the fund was too big, especially general.
Well, generalist funds, of course, can buy physical gold. And you've certainly seen that in the past. You've certainly seen, again, I mentioned when I came into this business, you'd look at any gold fund and any fund, sorry. This is very early in the morning for me. I'm not a morning person. Any fund would have some gold, and some of them would have physical gold. But that's what your comment is exactly, as you know, as we all know, that's exactly why companies like Newmont and Barrick are getting into copper. So Barrick now calls itself the gold and copper company, because to get into copper or something else is really the only way that they can become, meaningful global players. Yeah, no, absolutely.
What is the correlation between the gold price and the currencies, major currencies, such as USD, Euro, and Great British Pounds?
Yeah, since
going forward.
Yeah, I mean, since we in North America, we measure gold in dollars, so obviously, it's a very negative correlation. The dollar goes down, the gold price goes up, everything else being equal, that's going to be your correlation. Now, of course, when the dollar's going down, it's typically reflective of other problems. So typically, people will be buying gold, and the gold price will be going up even more than the gold price than the dollar price is going down.
Japanese yen, Euro, and the British pounds.
I mean, gold is the anti-fiat money, if you like. So when fiat monies generally are weak, then the gold price is strong. But I can't really say there's a more accurate numerical correlation. But I mean, gold will go up when fiat currencies are weak. When the global economy is strong, when interest rates are low, when then nobody wants to buy gold. It's only when things...
Crypto.
Oh, crypto. I have a little bit of a different view than a lot of people. I think crypto, the big demand for crypto has definitely, it's definitely taken some money away from the gold market. But my view is that it's nowhere near as significant as a lot of people think. To me, the typical buyer of gold is different from the typical buyer of crypto. And I almost think that in the end, it'll be a big positive, because when, the crypto market retreats to its inherent value, which it will inevitably, just like tulip bulbs in Amsterdam, return to their inherent value. Those people who bought crypto, because of their worldview, they're sort of vaguely, anti-establishment, they're anti-central bank, they're anti-fiat money, I think those people will turn to gold, which will have proven its value when crypto blows up. So I think we'll get more people coming into the gold market who perhaps otherwise wouldn't have done. But crypto really doesn't have much correlation with gold. It's much more correlated to, the tech stocks, to NASDAQ. If you're looking for a correlation, and there isn't really even a very strong correlation there, but it's more correlated to the NASDAQ type of sector. Well, thank you very much.